when we first start buying, we were very nervous and we want high cash flow. So the high cash flow normally more produced from those units without land. So you got 10% return, 8% return, even 6% return. With the interest coming down, the more options we are having. But then eventually we went to the properties with land. Means you are buying something with development potential. But we didn't do that because we are so busy and so focused for the property business, selling and buying, helping our customers. Only really last few years, we start thinking to develop the land. We land banked.
Yeah.
Yeah.
Welcome back, Leverage Addicts. It's your host, Blandon, and today we are talking about property developments. I'm thrilled to have a returning guest today, someone who truly embodies what it means to be a leverage addict. Last time we talked about her 8-figure debt, and this time we're talking about her developments that she has completed recently. Jane Wang, she is a real estate agent, one of the top for almost more than a decade now, I think.
Two
decades. So since she started in real estate, it's about a similar time when she was already started to invest in Mount Wellington area, I believe, from our last podcast.
Yes.
And recently she's got these 2 developments that she's completed. We got the valuations back. It's 13 houses in total. And she gained more than 4 mil equity. Now, this is based on if she sold the property today instead of developing, and then she developed instead, and she was able to realize that equity.
Yes.
So this is what it means to actually land bank and then see what it can become in the future. And I thought it would be really good for us to dive into sort of Jane's decision-making process in terms of when she decided to develop, why she bought them in the first place, or and also kind of look at what are the challenges as a developer, because especially in this interest rate environment, because she developed when interest rate went up from the 2%. How does she sort of handle that? And I guess for some of you, maybe earlier in your journey, I think this is going to be very insightful to what you could be potentially doing if you think about investing early. So Jane, welcome.
And thank you, Blandon. Yeah, I'm actually very happy and excited to come back for my second chat or interview, with you. So really thanks for the opportunity. But time goes really, really fast from last to today. Actually, I have done something new. So that's really exciting to discuss as well.
You're very welcome. I think last podcast did really well. We had really good feedback from the clients. It was a very inspiring story. And I thought now we can dive into a little bit of the details of, actually developing. And we could start off with just explaining the concept of land banking, because we talk about that a lot. You probably talk about that with your clients.
Yes.
Maybe explain to us on a high level, what's the advantage of that? Why would you want to do a land bank?
And I think as a real estate agent, we have done so many business for our clients, customers, helping them to find the right property. And some of them are homes, but some of them are good, very smart investors. So basically, I learn from them. Also, I started my own property investment from early years. So really, really benefit from that. The land banking is definitely the best you can do. You buy and hold, and the value going up, then you borrow money by using the equity from the bank. Then you grow your equity again. So the land banking is, I think for the first stage of my property investment, I just purely do the land banking. But then I went into property development. I found also even more fun and also more benefit for my stage.
So is land banking just buying a piece of land, or what is it? What does the property usually look like?
I think at the beginning we do cash. I think last program we said cash flow. When we first start buying, we were very nervous and we want high cash flow. So the high cash flow normally more produced from those units without land. So you got 10% return, 8% return, even 6% return. With the interest coming down, the more options we are having. But then eventually we went to the properties with land. Means you are buying something with development potential. But we didn't do that because we are so busy and so focused for the property business, selling and buying, helping our customers. Only really last few years, we start thinking to develop the land. We land banked.
Yeah.
Yeah.
Yeah, because one of the first one that you bought, you told me, was in 2005, and
Yes.
it was a $380,000 property
Yes.
in Panmure. And what was the rent like back then? Like, what were you getting?
Yeah, that's actually a really good example because we bought at 2005 as a rental, but then we also moved in to live for short while, and we paid for 380. The rent could be like 450. So it's kind of more than 5%.
Yeah. So back in 2005, the yield is already coming down quite a bit in Auckland, but you could still buy something that's semi-neutral cash flow.
Yeah, and because since 2008, 5 we bought it, but after like in 2011, the rent going up. We also renovate the property. The rent went up actually to $650 something like that. Yeah. So yeah.
So by then it's kind of break even.
Yeah.
So essentially, would you say a land bank is buying something is not just a piece of land? It's usually got some income on it. You want something that is relatively neutral, maybe positive if you could. But even if you had to chip in a little, it's looking at the long term.
Yeah. Looking at long term, you always cover your rental loss. And when the interest rate, because when we bought in a long time back, actually the interest rate is really high. We've been through less than 10%, but being 9.7%. And from, I think only last few years, the interest rate coming down to 2 point something. That's the lowest in the whole history.
Yeah.
So that pushed the land price going up very sharply.
So despite the market price that we're in, so the quick valuation on this property, Tuakiri, is $380K purchase price, 2005, and the build cost was around $2.2 million.
Yes, everything together, including architect, resource consent, building consent, all the preparation, and also the building cost, and also the council contribution.
Yeah.
So a lot of cost together. I think roughly around 2.2.
So this was locked in just after maybe the construction costs, started going up, but it wasn't at the max and wasn't at the peak.
No, not at the peak because we started building in 2020. So right like during the lockdown period. So we locked I think the cost before the peak, but definitely not the cheapest, and if we build earlier, we probably save a few $100. Yeah.
Yeah. And the titles, valuations we did was in 2023.
Yeah, we did the 2023 last year. So not the peak time as well.
Yeah. So around 2.6 mil of costs in total, but we've held for more than 20 years.
Yeah.
Close to 20 years, and the in valuation was $6 million.
More than $6 million, actually. Yeah. Even last year, I think the valuation still comes with more than $6 million.
So that's really good result because now, I guess the audience or for the listeners, they can see that, okay, it's quite powerful. You buy something that roughly neutral, hold it for 15, 20 years, and then because of inflation, the land cost goes up, and then now you do the construction, but you get a massive valuation gain because all the houses, they have a much larger margin.
Yeah, and also have much more income. So imagine, I think it's really good fun to, and we did the first development, from land banking only to the try the development. And we then even lockdown dragged the time for more than what we're expecting, but the result still make us really satisfied and happy. And also the cash flow becomes much higher. Before you're holding the land, you only get $650, $700 per week, but now we're getting like $800 per unit.
So you're getting a massive uplift not only on the value, but because of the inflation on the rent, every single property is like you're getting a major uplift on the rental yield on cost.
Yes,
that's really good. So I wanted to know a little bit more about the decision-making process, like because you transition, right? You went from like buy and hold for a long time. You carry on with doing your job as a real estate agent. So what was the process in terms of when to develop? Like, why did you feel like couple of years ago was a time that you should do it?
I think confidence. When you're more confident with everything, then you could be more brave to make the decision. Like when we first start a real investment, we only want to buy cash flow because we feel there is no stress for your income, and then the rental will cover or the mortgage. Then you become more confident. Then we start buying property with land. Land banking. You have less cash flow. You have negative cash flow, but you are confident you're making more capital gain. I think with time goes by, we feel basically we bought the land 20 years ago. Then the land almost nothing really. Become non-cost. So really focus on the building cost. And also by looking the cash flow return and also the capital gain, we feel we are happy to carry the higher risk to do it.
Yeah.
So,
And would you say this is a factor that plays into it? Because you bought the land quite a while ago.
Yes.
And so that mortgage would somewhat be either nothing or very, very low. Whereas maybe if someone like, okay, we'll take out a mortgage right now, I could borrow 70% on land, and that doesn't really leave them much room in terms of like, being confident. Like for you, it's like, well, you've got a freehold piece of land, you only need to borrow the money for the construction.
Yeah. Yes.
But in this case, you didn't even borrow the money from the construction, did you? How did you go about the financing?
The other side, we are still like kind of conservative, property developer. We are probably more invested to develop for investment, and I think when we thinking to develop, also the market is really, really positive. We really good. 2020, 2019, our sales also going very well. So we always have I think that's our focus. I think in the last program interview, we seeing as well. We always focus in our business, our own business. Me and my team and my husband, we spend all our time and focus in real estate business, our job. But I think for development, the other things we really enjoyed because you don't need to really work in the project yourself, right? So you are actually allocate the project to the builder to complete. So I think that's another beauty. It's like our side bonus, not even a business. You just assign the contract for the builder to do the job for you, and all you need to do is organize the funds.
Yeah.
So that's very different from our real estate business. We're making good cash flow, but we have to work every day. So I think for investors, build to have higher rental income and also more instant equity development definitely add a lot of fun to our profile.
Yeah.
New achievement. Yeah.
That's great. And for this particular project, for Tuakiri, I couldn't remember exactly how much of it was, funding externally and how much was it from cash from selling your houses?
Yeah, for the Tuakiri, because I think also we said we don't borrow too much money. I think because we paid the land really long time back. So the valuation, when we start building, the valuation of the land actually worth much more than 380. So basically, you don't need to. You can just I think we're just revolving the money from the bank.
Yeah. So did you have to sell like maybe another property? I remember you sold something for something like $1 million and you had extra cash.
Yeah, you reminded me. Yes, that's good reminding. And I think at the time I sold 3 unit title property units.
Yeah.
So see, I bought like the one Palama Road, 176 Palama Road. Really, also like before I bought Tuakiri, cash flow 10%. I paid only for 120,000, and then I'm renting for 250 minimum from the beginning. So actually, that's 10% return. So I think when I start building, when I decide to build, and I decided to sell those cash flow, but really. Yeah, I don't really see much potential for the future. So I sold 3 units, which I bought really early stage, and also has a body corporate. I feel property with body corporate is really getting harder to sell. So I think that's really, even I sold those units before the peak time, but I think I made a really great decision because I had those cash to put into the development. And then I have much less financial cost for the development. Yeah.
So if I was to sum up the strategy, you basically had a land bank to start with. You paired it with a couple more cash flow properties, so you've got your, a basic portfolio.
Yes.
And over time, the land bank value goes up quite a bit.
Yes.
You're able to just sell the cash flow property that was supporting the land bank in the beginning.
Yes.
And because of the capital gains, you now have a cash injection into the development.
Yes.
And now you can just go do the development without putting in too much new debt.
Yes, exactly. I think that comes together really well. Yeah, that's like the strategy together. Cash out some money from the old investment. You don't pay tax. So that's the buy and hold really, I think when you cash out the money, the buy and hold strategy is really working. And then we don't add the financial cost, and we feel much more safe and comfortable. And thirdly, we still can carry our real estate job because we don't need to spend money for really. We just go in, look the process. We don't need to spend time. So I think it's great. And also with the confidence, you grow, then I think everything comes together really, really nice.
That's great. And I want to know what the downsides are. What are some risks and challenges you ran into?
Definitely. I think a lockdown is unexpected.
Yeah.
And the timing, it's out of control, basically. Then even we push the builder every day, but he can't finish the job within what we signed, And of course, there is good reason lockdown, but I still see people finish the building much earlier than us. So maybe I have seen as agent, I've seen other worst scenarios.
Yeah.
So basically, we are kind of not the worst, but not the best.
Yeah. So some things are uncontrollable for you and may drag the timeline a bit longer.
Time costs money because if I can finish if I can get the title not last year, if I can get the title even half year earlier, I think my financial situation for the second one will be much better. It influenced my following development. Looking okay because I'm not selling, but if I was in a scenario to sell those properties, that could cost a lot of even more costing. Yeah.
Let's talk about the Kings Road one because you took a different approach with this one. You bought this one a bit later in 2017.
2017, yeah.
1.3 million. The build costs, you had to pay a much higher contract for the construction cost, which is around 3.6 million. This is for 7 lots. And you got an end valuation for more than 7 million. The financing strategy was a bit different with this one because you were kind of a lot more confident. Like I felt like, okay, you know how this thing works. And you're just like, okay, I don't need bank finance. You're happy to go for a second tier lender. What was the decision-making process with that? Like what are you thinking about? It's like, okay, why would someone even consider second tier finance?
With my profile, the bank not approachable anymore. And also, with the first project, success, and also I have 6 equity-free property, and with the cash flow. So that gave me the confidence to pay more interest to have the second project finish, and also by getting join the lesson from last time, I get a much better builder. So I pay a higher cost, but I think the second builder is more professional.
They're faster, much faster than the first one.
Faster. So I think the second project completed within from October to May. It's 10 months. Yeah. And also the cost high is because it's 3-level building. Yeah. And also the appliance, everything, like the
top notch.
Specification is higher. Yeah, better quality, better location. It's in the Golden Triangle.
So what's the exit strategy for this one? Because okay, you know how the building works. You can get the second tier lender because you're in a position where you've got a ton of equity now because you built those projects. You were able to sell down a couple of smaller properties, and then you're like, okay, I want to build it now. But how are you gonna take those lending out of the second tier? What is the plan there?
And the plan is to complete the project faster, more in time schedule. And also then I get, from one single income, I get 7 incomes. So my cash flow is quickly pumped up. And also my equity, from 1.3 million, even can be valued for 2 million. But once I finish the project, it's worth at least more than 7 million. And so I think within 1 year, if I can do this, complete this project, then I don't mind to pay more interest.
Are you planning to sell down some of your other properties potentially to pay down some of the debt and then look to refinance remaining portion?
Yes, and I think when this project is finished, then I'm planning to sell some older properties, to restructure the whole loan. And also with the interest going up, we are under more like higher risk. So for my strategy, I think sell those old ones, some of the old ones without paying tax, but also holding these new ones with higher cash flow. So I think that's a whole strategy. Also, I would like to pay back those second tier mortgage, as early as possible, probably. Still go back to the bank.
That's really awesome. I just on the sideline watching like all of this unfold, like people talk about it, but you're just like making it all happen, and you've really done the time to do it as well. I want to know, if someone is starting out, if someone is starting out in property development or wanting to buy something, to do something like what you're doing in the future, what advice would you give them, and what would you get them to focus on in terms of, what should they look for in this current market?
And now the market the last 2.5 years, changed hugely. So basically the whole market being washed again, and then the price has come down to the land. Land actually now I think it's a really good time to buy the land and the land banking again, because the money you paid for the land, for the property with land, I feel it's kind of go back to 2017, 2018 market. So if we see that because of the terrace house selling for so high, bring the bubble of the land. But I think now all these bubbles are gone. I think, and then the land when you're going to a very reasonable level, I feel it's a good time to buy and enter the market for the land banking again, like what I did the exercise from the before. So I think I never worry about to buy at the top of market, like the Kings Road one, I paid for the top market. It's 2017. I paid for 1.3, but that's definitely at the peak time. And in 2017, the interest rate is much higher than later on. So I think the price gone up to really crazy because the interest rate coming down to 2.99. If the interest rate is stabilized at even 5% something, probably the price won't be so high. But now I think the price has come down to more realistic level. I think the risk for the people to buy land banking now is very little. So I do feel it's a really, really nice strategy. If you haven't started, if you still have the ability, to borrow money from the bank, definitely start now.
That's awesome. And what would you say are the key things you want to look for in a property that you want to develop in the future?
You mean for the people who haven't enter into the market yet, or?
Yeah, so someone may be wanting to buy something for the long term and they want to develop in the future. What are some key things you would say they should look for?
I think buy and hold is always good. Buy and hold always safe. And if you want to buy and develop it later, you need to also look in your financial ability. To build new houses, that costs a lot of money. So either your own money or the second tier or bank money. So I think before you enter into development, do need to consider more factors rather than looking at other people's successful cases. I said, I can do it. I borrow the finance. So I think that's much more to consider.
Yeah, definitely. And I guess, let's say if they have a very long-term mindset. Let's say, okay, well, I'm just going to buy this and hold it for a long time. And I'm going to hold it for at least 10, 15 years. What are things that you go, okay, these should be on a checklist on a property?
And I think for the, if you want to develop later, obviously you have to buy something with land, not just cash flow. And or maybe some land with double income. It also can be considered. That's nice to hold. You have, like I'm selling quite a few property with double dwelling or even triple.
Yeah.
So those properties are maybe very nice to consider to hold for 5 to 10 years.
Yeah.
And for New Zealand properties, normally 7 to 10 years doubled. I think should go back to the rule again because our price already coming down. Really, I think the price peak time during the lockdown period because many reasons, like so many overseas people coming to the New Zealand push the price up. I think all this already gone. So I think that's checklist. Maybe look in the cash flow, see whether you can get a better cash flow if you don't develop tomorrow. You just want to develop maybe 5 years later or 10 years later, like I did. So I think look in the cash flow, trying to buy maybe double dwelling. Or maybe something in good condition. You don't need to really cost too much to maintain it in the next 5 years. So I think anything 4% plus may be worth to consider. That's what I'm thinking.
That's awesome. And okay, now I might ask you a question that people might think is biased because you're in real estate, but at the same time you're a very experienced investor. So if you looked into the future, where do you see property prices in the next 18, 24 months? What do you think the market's going to look like?
I think we have been really waiting for so long. And as a real estate agents, we have been through really hard time. I never see market so slow. And we have good listings, but no one come to the open home because people are so scared or because the economy is so bad, So next 18 to 24 months or like 6 months to 24 months. I think July is a good, showing some good signal because our Buffalo sales July has 1/3 more than June.
Wow.
Yeah. So on the other side, we have kind of also more listing coming. And so it's like more sales, more listings. So I feel still buyer's market. The buyer is really in a good position to
So you're
choose.
seeing more activities in the market overall.
But definitely good sign, the more activities coming to the market. So with the interest rate truly coming down some, good level, before they just talking. But I think now all the medium is saying the interest rate definitely coming down. The OCR is coming down, so it's truly happen. I think for the buyers, many buyers, they start panic again, so they want to take action. So I think next 6 months to 12 months should be more stabilized sales activities. And after 12 months, if the interest rate really coming down to good level, say for example under 6, I think the market should pick up back much better.
I see. That's really good insight. Thank you so much, Jane. And again, we really appreciate you being very open with your story and some of the numbers. And I'm sure listeners will appreciate that. And for our listeners out there, if you guys are considering, buying in Auckland, Land Bank, you know who to call. And again, thank you for the value you provided today. And for everybody that's still listening, remember, if you guys have found value, share it with one person. And I always appreciate if you leave a comment on what we can improve on the podcast. So until next time, I'll talk to you guys again. Thank you, Jane.
Thank you, Brandon. Yeah, very, very glad.
Awesome.